You know, we hear about the Federal Reserve, the Fed, all the time, right? Interest rates, inflation, the economy. It's kind of presented as this financial safety net for the country. But what if that safety net is actually full of holes? We're about to dive into a historical analysis that asks a really tough question. Is the Fed truly serving the public, or is its track record telling a completely different story?
So this is the official line, and it's coming straight from the top. The mission, they say, is a single-minded focus on serving the public. I mean, that sounds great. It's this powerful promise of ethical, unbiased control over our economy. This is the ideal. But the real question is, does it actually match reality?
And yeah, right away, here's the clash. The source material we're digging into argues that when you actually look at the history, that promise of a single-minded public focus just gets shattered. This is the central conflict we're about to unpack.
Okay, so to really get a grip on the criticism, we first have to understand the promise itself. Let's lay out the baseline. What is the Fed supposed to be doing? Because only then can we really examine the source's claims about what it's actually become.
So what even is the Federal Reserve? Officially, it's supposed to be an independent central bank. But the analysis we're exploring suggests its relationship with the government is, let's say, a lot cozier and way more complicated than that simple description lets on.
On paper, its job seems pretty straightforward. The Federal Reserve System is the central bank of the U.S. Its whole reason for being since day one was to bring stability, and this is the key part, to prevent the exact kind of financial meltdowns that used to wreck the country.
And if you look at its history, a really clear pattern starts to show up. It was created way back in 1913, but its power has never stayed the same. Check this out. After every single major financial crisis, the Great Depression, the 2008 recession, its authority and its responsibilities grew. A lot. It's like with each failure, it just gets bigger.
And its official to-do list? It's huge. We're talking about maximizing employment, keeping prices from going crazy, regulating the entire banking sector, and protecting consumers like you and me. These are the big benchmarks it's supposed to be measured against, so keep them in mind.
This brings us to a really crucial point: its independence. Officially, the story is that the Fed operates on its own, without needing a thumbs up from the president or Congress. But the source we're looking at points to a huge catch. The president appoints every single member of the Board of Governors. The analysis calls this a symbiotic relationship, which makes you wonder, just how independent can it really be?
So, this brings us to the core piece of evidence in this whole argument: the 2008 financial crisis. This whole event is basically presented as the ultimate pop quiz for the Fed's mandate. A quiz that, according to this analysis, it failed. Spectacularly.
To really get the scale of what went down, just look at this number. $85 billion. That's how big the initial loan was that the Fed approved to save just one company, AIG, from going under. And remember, that was taxpayer money being used to bail out a private company that was called too big to fail.
And this is where the source really drills down on its main complaint. While the Fed was busy orchestrating these massive bailouts, the executives who were responsible got millions. Joseph Cassano of AIG, some people called him the man who crashed the world, he walked away with $34 million. But at the same time, as you can see from the data, hundreds of thousands of their employees lost their jobs. The difference there is just staggering.
But hold on a second. Wasn't the Fed's whole job to stop this from happening in the first place? Well, according to the law, yeah. The U.S. Code is super explicit that the Fed has a duty to watch out for undue use of bank credit for speculative trading. In other words, its main job was to be the watchdog.
So the accusation from the source is simple and it's direct. These legally required oversight procedures just weren't followed. This wasn't some small mistake. It was a total failure of a primary duty, and one that, according to the analysis, directly paved the way for the 2008 economic collapse.
But the criticism doesn't just stop with the banks. The analysis argues that this failure to keep an eye on things is part of a much bigger issue: a systemic lack of transparency that goes all the way to the top of government, raising really serious questions about insider trading.
The source claims that because Congress gets regular updates from the Fed, some members get access to critical market information before anyone else. It actually names some very high-profile politicians alleging they use this inside track to make stock market investments that turn them into multimillionaires.
And this is where the source points out what it calls a glaring double standard. I mean, if you or I did this, we'd probably be facing indictment by the SEC for insider trading. But at the time, members of Congress didn't have to follow the same reporting rules, which created a system where the rules seemed to apply to everyone except them.
The analysis puts a spotlight on Barney Frank, who at the time was the chairman of the House Financial Services Committee, so a key oversight role. It alleges that he was on national television telling the public the market was fine, while at the very same time he was selling off his own stocks, getting out before the crash he was telling everyone not to worry about.
So after laying out all this evidence from the 2008 crisis and these allegations of insider trading, the analysis gets to its final and, well, its most provocative verdict.
The conclusion here is not a call for a few reforms. It's not a call for new leadership. The source's argument in the end is that the Federal Reserve has fundamentally failed in its mission to be an economic safety net for Americans, and because of that, it should be completely dismantled.
And all of this leaves us with a final, really critical question. This analysis presents a powerful case for institutional failure. So whether you agree with its conclusion to dismantle the Fed or not, it forces all of us to ask, when the very institutions created to protect us are the ones that fail, how do we demand accountability? Who is watching the watchers?